everybody. Welcome to today's 1Mby1M podcast. I'm here with Chiu from XSeed today, and we will be talking about Alan's fund and all these cool activities from XSeed. Welcome, Alan.
Hello, everyone. Happy to be here.
So let's introduce our audience to XSeed. Tell us about the firm.
Sure. XSeed is a seed-stage focused technology venture firm. We look for the best entrepreneurs we can find who are building technology startups and get some capital to make their dreams into reality.
And how big is the fund?
Yeah, we're investing out of our second fund. It's $60 million. Our average check size is typically around $750,000 to start, but we don't have straight guidelines on how big that initial check is. It really depends on the needs of the company and where they are in terms of stage of development.
Okay. And what about stage, where this $160,000 average, $150,000-$60,000 average, this would be a pre-seed, a seed? So where would you put that?
Yeah, it's $750, so it's institutional seed. The round size usually is around $1.5 to $2 or $2.5 million.
Okay.
So a lot of times the entrepreneurs had made a lot of progress based on the pre-seed round they had raised from angels or family and friends.
Okay. So what about industry sector? What is your comfort zone, preference, focus?
Yeah, we generally look at B2B or enterprise opportunities because we believe that at the seed stage it's easier to assess the potential of B2B opportunities versus more consumer mobile, consumer internet startups, which usually take a little longer to validate market needs and see that it's sufficient user growth over a longer period of time to know that this product really is hitting the consumer zeitgeist. So we tend to focus on more B2B opportunities, and that's also the majority of my background as well.
Okay. And what about geography?
Geography is U.S. focused. Most of our investments are made in the San Francisco Bay Area. We do have a small number of companies that are based outside of this region. We usually do that if we find that the entrepreneurs to be especially compelling, and we're able to find local investors to support the entrepreneurs and make local introductions when it comes to talent recruitment or opening doors to customers.
And what I imagine that you are seeing a lot of companies that are not just Bay Area, completely Bay Area based, right? They may be having their front end in the Bay Area, but they're doing development somewhere else and stuff like that, right. And that's an acceptable configuration?
Oh yeah, absolutely. We're seeing more and more of that, in fact. Often because they have good talent elsewhere that they want to bring on board and don't want to move them to the Bay Area for financial reasons and for the employees' own personal or family reasons, and that makes a ton of sense. So that's very common, having a development team elsewhere for the commercial team in the U.S. or in the Bay Area.
Yeah, okay. Tell us about some specifics of what you are looking for right now that you would like to invest in. Have you come up with specifics?
So we're not sector focused at the moment. So first and foremost, looking for the most compelling entrepreneurs. And what do we mean by that? These are entrepreneurs who are always able to create momentum regardless of the obstacles in front of them. They are high energy. They attract top talent around them. And they are what we call truth seekers. And that's hard. Entrepreneurs are very opinionated and headstrong to begin with. Otherwise, you wouldn't be starting out on your own and starting a new company. But you got to balance that with being adaptable and coachable and be able to learn from market feedback. And the focus is on getting it right rather than being right. And so that's one of the key qualities we look for in entrepreneurs.
Talk a bit about your current portfolio. This is your second fund. How much was the first fund?
The first fund was $50 million, and it was invested across clean tech, life sciences, as well as software.
And how many companies did you invest in from the first fund?
I wasn't with XSeed in the first fund, so that's not a part that I could really speak intelligently
Okay.
about. Yeah.
And when did you raise this fund?
Yeah, so I've been with the second fund from the beginning, and we've invested in more than 30 companies. A number of them have grown to be pretty significant entities. There's a company called Zoos, which is based in Israel, is a payment gateway and payment analytics companies. They've got large customers such as Burberry using them. They are especially strong in handling cross-border payments. We also have an enterprise business intelligence platform company called AtScale that is enjoying tremendous growth, and some of the largest financial institutions and retailers and gaming companies, basically any enterprises handling billions of data points would find AtScale to be indispensable.
And that's what kind of use cases is it gaining traction in?
You mean AtScale specifically?
Yes.
Use cases as in, if you can imagine a retailer with a lot of products in the inventory, with a lot of variety and with a lot of vendors that they're dealing with, and trying to predict demand for specific products and specific geographies. That's very, you got to process high volumes of data very, very quickly and try to make decisions that will have a direct impact on your margin. That kind of use case that AtScale really shines.
And what stage did you get involved with AtScale in? What did they have when they came to you?
From the very beginning, they were actually still building their product, no customers yet. But credit to the team, they had done dozens of customer interviews, very, very strong background in business intelligence. So they knew what they were doing, and they were solving deep customer pain points that nobody else were solving yet. And they took a very unconventional approach from a technology standpoint. So there was a lot to like about the team. Unique technology, deeply experienced team, a team that had worked together before, solving a big problem.
So you would be okay with investing in companies at a stage where there are no customers yet, the product is still being built, but there has been a lot of customer immersion in designing the product?
Absolutely.
And you have it sounds like you have a group of investors that you co-invest with who are okay with that stage of businesses as well.
Yeah, no, definitely true. Certainly, we're taking on a little bit more market risk if we're investing pre-revenue and pre-customers. So, but if that could be balanced off against a very strong team who understand the market very, very deeply, that reputation and track record will make up for the market risk that we're taking on.
And who are the funds that you co-invest with that same stage thesis?
Yeah, it's the usual suspects in the seed institutional seed ecosystem. We've co-invested with a lot of high quality seed investors that we're very, very happy with, and our founders are very happy that we're able to pull together a syndicate that's collectively.
Can you name some of the funds that you've co-invested in these deals with?
So we've co-invested with Storm Ventures, with Ulu Ventures, and Engineering Capital, and many other seed firms.
Okay. If you look back on the year 2017, which just ended, what are the trends that you see in your deal flow? Not necessarily the ones that you've invested in, but overall, it's like from a much broader pool of deals, what highlights, what trends stand out?
I'm seeing more and more entrepreneurs who are being extremely capital efficient, which means the bar for getting investment continues to move up, whether you're raising money from institutional seed investors or Series A investors. Entrepreneurs are able to get more done with less capital. That's a continuing trend. We're seeing not a slowdown in deal volume, but in the investment pace, and that's not new. That's been going on for the last 2-3 years, and I think that's a reflection of the fact that we've had an explosive explosion in seed investments 4 or 5 years ago, and they're still working through the system. So many of the early investors felt that they wanted to see some of these companies exit or have a liquidity event before they pick up the investment pace again. So we are therefore coaching the entrepreneurs that we back to allow for a little bit more buffer in the runway to give them more time to hit the milestones, allowing a little bit longer cycle for fundraising, just adjusting to the new reality of early stage fundraising.
So let me see if I understood what you're saying. You're seeing more capital efficient execution, which is good, which is a very good thing. In our philosophy, in the 1 million by 1 million methodology, we strongly recommend that people bootstrap and be as capital efficient as possible, as long as possible before raising money. And even if they raise money, we prefer that they don't raise huge amounts of capital, which is completely counter to the unicorn mania that has been running through Silicon Valley, which we'll talk about in a moment. So I think the capital efficiency trend is a good thing from what you're pointing out. The trend of, let me see if I understood what you're trying to say here. You are saying that there have been a lot of seed investments in the last 5 years, and right now, these companies that have received seed investments, the people who have invested in them are trying to get exits and not making a lot more seed investments. Is that what you're saying?
I think the bar has gone higher. And
for Series A.
Right, for seed and for institutional seed. So fewer seed, if you look at the data, right, fewer seed investments are being made, but the companies that are able to raise a round, they're raising slightly bigger rounds. Right.
So, well, I think there are two points that I'm seeing, which is there are a lot more, what we call micro VCs in the system. There are a lot of 15 million, 20 million funds in the system right now than there used to be. So there is like this very small amounts of capital is still in the system and they are getting invested. And some of these are very new funds. They just came up in the last 1 or 2 years. But the bar is very high. For getting any kind of Series A is very high bar. Yes, so the Series A gap is tremendous and growing.
Yeah. No, that is very true. And what we're seeing is even there is going to be a gap going from pre-seed to seed as well.
Yes, and that gap is going to grow as well for the same reasons that the seed guys are looking for a higher bar, and going from pre-seed to seed is also going to be a bigger gap as we go along. Yeah. So what about unicorn mania? How do you parse unicorn mania?
I think we went through a period where raising massive amounts of capital in and of itself was viewed as a sign of success, but more often than not, it leads to undisciplined growth. But I think we are backing away from that as an ecosystem. We're seeing fewer huge deals. Not that they're still happening, especially with SoftBank investing in and making later stage investments, and sometimes crowding out even some of the top firms around the valley. But that aside, I think overall for the majority of the companies, we're reverting back to a more normal, rational, sane level of late stage investing, which I think is healthy.
And what is, as a fund that is in the, let's say $50 to $100 million fund size level, what, in your opinion, is the right strategy in terms of exits? Do you exit into some of these later rounds, or do you stick around? That is
highly deal specific, but in most cases we stick around. Unless the company ends up raising a round at a valuation that we believe is just so high that it will be very difficult to grow into. But that's uncommon. That's rare. So in most cases, we keep our pro rata, we continue to support our companies, and we want to keep investing in our winners.
Mm-hmm. So your thesis is that the kind of bloated valuation, or your observation is that the kind of bloated valuation unicorns are not as common, at least that's not what you're seeing in your portfolio at the moment. So the case for exiting into later rounds is not as urgent.
Right. We're seeing fewer irrationally priced later rounds, and therefore we don't feel the urgency to exit at those rounds. We'll just continue riding the growth of the companies.
Are you looking for these billion-dollar opportunities, or are you also interested in the smaller, opportunities that abound in the ecosystem right now? Primarily because we are in 2018. Lots of stuff have already been built, and especially in B2B, there's a lot of sizable companies out there that are doing lots of stuff. So the gaps are more in the niches, not as much in the the front and center opportunities that have already been catered to. How do you view the smaller niche opportunities versus the larger opportunities? Are you only looking to invest in the larger ones and disregard the smaller ones? Or do you have an investment thesis around smaller TAM opportunities as well?
So no one would ever say that they would. Everyone welcome a $1 billion outcome. No one would ever say we don't want them. But one of the advantages of managing a smaller fund in the $50 to $100 million range is we could actually meet our numbers expected by our LPs, our limited partners, our investors, without necessarily having $1 billion exits. Right? So we have a little bit more flexibility to generate the kinds of returns that we need to without relying on unicorns. So that's a plus for us. That said, going in, just because of the inherent uncertainty in starting a company and assessing the size of opportunities, we'll still like to see the potential for a company to grow into a unicorn, even though they don't have to be in order for us to succeed. Just because usually both early stage investors and entrepreneurs, when they're starting a company, are very optimistic about the outcome. And you have to have that level of optimism and hope in order to get something going. So the reality would then eventually come in and start discounting on that. So we still like to see the potential to be in the billions. Niche opportunities are still going to be more challenging to look for venture backable returns in more niche areas. Not that it cannot be done.
The question that I'm constantly intrigued by as I talk to many investors is that how can so many investors all find unicorns? It's just not mathematically viable to, if you're obsessed with just investing in companies that have the potential of being unicorns, there aren't that many of those.
That's very true. That's why they're called unicorns. There are very few. That said, though, the world is shrinking in the sense that we're seeing companies go international earlier in their life than perhaps previous generations of companies. And so while the absolute size of these markets may have been growing at the pace of GDPs, but the ability for startups to reach into these markets has increased substantially over time. Companies are able to expand beyond their indigenous markets, beyond the U.S. market, sooner rather than later. And growth has a direct correlation with valuation. So that helps to create more highly valued companies sooner than before. But yeah. Yes, they're still rare.
And that's why and also I think management teams that can pull off unicorn level growth. It's hyper growth is a rare phenomenon, and there are very few management teams that have the skills to be able to pull off hyper growth. That's another limiting factor as well.
Yes, very true.
So at the same time, I do think that there are lots of smaller opportunities, 100 million TAM, 200 million TAM kind of opportunities where you can, you do some level of execution, get to a certain amount of revenue, and then you sell to the companies who has a channel adjacent to yours and what you're looking for, and don't invest in building the channel. I think that you could get very nice multiples on small capital efficient deals, and everybody makes money in that scenario.
Yep, very true. And we will welcome those
exits for the small funds. Sorry?
Having multiple of those kinds of exits could make up for one unicorn or half unicorn, right? That's right. Instead of one unicorn and 9 failures, if you have 5 decent-sized exits, that could also make. I mean, it works for a smaller fund. It doesn't work if you're trying to, do very large funds. You can't really do these small capital-efficient deals. That's just not going to cut it. Exactly, which explains the proliferation of smaller funds.
Yeah. Yep. So, what else do you want to convey to the audience that would be interested in working with you as parting comments?
I would say surprise us. Yes, the general notion is that people don't know what the next big platform shift is going to be. Is it blockchain? Is it not? ICO craze kind of tanked the whole blockchain ecosystem when the bubble burst. Nobody knows. There's a sense of uncertainty around what's the next big wave that will usher in the next generation of world-dominating tech companies. But I would argue that now is precisely the time where the best and most insightful entrepreneurs are already identifying the non-obvious opportunities that are invisible to most investors and already working on them. I would love to talk to you if you're working on one of these opportunities. Because if we believe that if we're that smart to predict the future and come up with these opportunities on our own, we would be entrepreneurs ourselves, right? But no.
That's right. And the entrepreneur always has to know more than the investors. It's a requirement.
Yeah.
Very good. Thank you, Alan. Thank you, listeners, for listening today. And if you're enjoying these sessions, please go to iTunes and rate the show. And come to one of the weekly roundtables where we have had an opportunity to work on your business. Go to the website 1Mby1M.com. Go to free public roundtables and register for a slot to actually work on your business. And we'll strategize, figure out how to remove your roadblocks and guide you through the acceleration journey. All right, and we'll see you soon in the next episode.